Hello, everybody. Sure, what a interesting time we are living through at the moment. We've probably seen over the last quarter probably one of the toughest times in probably the last 12 or more years in global bond markets. It's not just been in South Africa, it's definitely been across the globe. So I've said to quite a few of our clients already that I think previous to 2022, a lot of the drivers of global bonds was obviously this whole QE and the low interest rate cycle in the world. We've obviously seen this change dramatically in 2022, and especially over the last quarter, we've really seen these global central banks step up the rhetoric in terms of their hawkish stance. We've probably seen most central banks in the world hike rates. We're a little bit surprised though, even how hawkish the US Federal Reserve has turned, hiking by 75 basis points earlier in the quarter. We thought that the ECB would probably maintain their rates where they are. Now they're talking about a rate hiking cycle as well. We've seen the South African SARB hike rates. So most central banks in the world are on a hiking path because of what's happened to global energy prices, food prices, and inflation is very high at the moment. And that's obviously the reason why global bonds have not done well. But it doesn't mean that other fixed income asset classes haven't done well. I think that we've seen good returns or decent returns out of the cash market, and we also have seen very decent returns out of the inflation bond market. So yes, over the quarter, nominal bonds have given you a negative return and very low returns over the last year, but inflation bonds have returned around 3% this quarter and over 10% over the last year. So definitely that hedging effect from cash and inflation bonds have really helped the portfolios where most of your nominal positions have turned negative. We've seen nominal bonds doing basically minus 3% over this quarter. You would not be surprised, So the South African 10-year bond yield probably went from around 9.5, all the way up to close to 11%, and that's why we've seen the negative capital element on bonds. Just looking out forward, I think it's going to be a bumpy ride going forward. So markets still need to work out where is going to be that peak in inflation, and that's for South Africa as well as for the globe, and especially for the US. And then the second point will be is where do we think that central banks will actually hike rates? So I don't think we should expect that central banks would suddenly just stop. I think they're going to continue hiking in 2022. So expect higher interest rates for the rest of the year. So it's going to be a bumpy ride in fixed income markets for the next 6 months. But there might be a good surprise for us in 2023, depending on what is going to happen to inflation and where do we actually get to that peak of inflation. That's on the globe and even for South Africa. So expect that the SARB will continue hiking, taking the current repo from around 4.75 all the way up closer to 6%. And then I think when they get to that 6%, maybe we'll just have to see that they stop and start a little bit and see what happens, because growth is definitely going to taper down. And there's lots of talk and speculation about a growth slowdown globally, as well as in South Africa, talks of recession. Now, once you get that, then central banks will probably be forced to cut rates again. But that's the environment where it will be positive for bonds. But that's a 2023 story. For now, we are going to be in a bumpy ride. So it's probably better to be more in a cash position, have more inflation linkers until we get to that top of interest rates. So yeah, good luck out there. It's a tough market, and it's going to be tough for the next 6 months. Thank you.